In this video, I'm going to talk about 3 stocks that I think are relatively resistant to tariffs versus 2 stocks that could get totally crushed in the event that tariffs between the United States and its major trade partners materially worsen. Let's jump right in. Welcome back to my channel, guys. If you're new here, make sure to hit the thumbs up button and subscribe if you're interested in stocks, investing, and trading in them. We're going to be talking about a couple stocks today that I think have the potential to do really well in all of this. So let's jump into a couple of the tariff-resistant stocks that I think could hold up well. Now, I need to clarify, when I say tariff-resistant, I don't necessarily mean that if global sweeping tariffs come into the picture, that these stocks are going to go to the moon. I rather think that these stocks would hold up better in a tough market environment than the ones that are going to be way more susceptible to tariffs. With that clarification in mind, let's jump into the first stock. So our first stock is going to be Uber, and taking a look at the weekly chart, you can see this stock has been on a phenomenal run in recent times, with the weekly moving averages looking very, very strong overall, and a clear momentum move to the upside here. And I don't think that it's coincidental that the Uber stock price is not too far off from its all-time trading high, despite all of the craziness with tariffs. Now, around that Liberation Day where Trump announced all of the different tariffs that were going to go into place, we did see Uber initially drop, but notice the resilience of this stock price. By the end of April, not only had we made back those losses, but we were right back to all-time fresh highs. And this resilience in stock price is part of the reason why I think the market is telling you that this stock is relatively tariff, quote-unquote, resistant. Again, it doesn't mean that tariffs and changing market environments and potential recessions and all that stuff can't cause Uber, like most stocks, to fall. But the resilience of this stock to bounce back so aggressively, even before trade deals had been announced, that is a pretty impressive price action response from this stock. Let's take a quick look at Uber's income statement. What you can see here is we do still see rising overall revenue, while net income came down in their latest reported filing. You can still see the big one for Uber, which is all about the rideshare model that they are trying to break in globally on and have done, in my opinion, a very good job at so far. They are growing their revenue, which is really important to a business like this. You know, the thing is, a lot of times people will say, well, what about their net income? It seems kind of choppy and all over the place. Well, Uber right now is very much, and has been for some time, in an investment stage of its growth. What I mean by that is they want to break into new markets and market and advertise so that Uber is more and more of a household name and the first thing you think about when you want to catch a ride somewhere. They want to grow that market share all over the world, and then maybe they can focus a little bit more on getting peak profitability out of the model later on. And with this growth in earnings and revenue, we can actually see that the price to earnings ratio for Uber has dropped pretty nicely over time. In fact, in the last year, you can see we've actually seen the price to earnings ratio consistently fall despite the stock price going up. To me, this is a good signal that the growth of the company and the relative valuation, while at one point looked very expensive, looks far more attractive in recent times. Here's a quick look at the free cash flow of Uber as well. And we can see as the revenue has gone up and the stock price has gone up, the price to sales ratio has also remained relatively stable. Also, I wanted to let you know about our free Telegram channel for stocks and options. If you're interested in stocks and want to see our charts of the day and things that I'm looking at in the markets on a more real-time basis, feel free to join our free Telegram channel. The link is in the description down below. Now back to the video. And here's a quick look at my own portfolio, where I do actually already own shares of Uber. I have an average stock price of just around $67 per share. I own 200 shares, and I bought it during all of the craziness that we saw in the April 2nd tariff stuff. During that time, I made the decision that I liked this stock and I thought that it would be tariff resistant, and I was right about that. Now, Uber could still fall if we see a recession, don't get me wrong, but I think the resistance to the tariff uncertainty is strong. So let's dive into this concept for a second. Why would Uber be less susceptible to sweeping tariffs? Well, let's think about it for a second. Tariffs impact imports and exports in the United States and to other countries. But what does Uber import or export? I'm sure they import and export some things, but the majority of their business model is domestically done. Their service, which is of course ride sharing, is not something that you need to ship in across borders, right? It's just something you sign up for locally. You pay your Uber fee, the driver gets paid. It's a localized kind of business, even though they're operating all different sort of jurisdictions. Uber is less susceptible to import and export duties. The next stock on our list that I think is tariff resistant is Netflix, which is proving to be one of the best stocks in the market this year in the S&P 500. Netflix is doing phenomenally well for multiple reasons. Going back to what we just talked about with Uber, obviously the concept being, hey, we don't need to worry about imports and exports very much. That also applies to Netflix. But there's another component to this. If we do see sweeping tariffs and it causes people to totally freak out, panic, and enter into layoff season, recession, all the terrible things that could come with a breakdown in the global economy, what happens to Netflix? Well, investors seem optimistic in recent times, and I actually agree with this, that the Netflix subscriptions don't necessarily stop in the event that there is some sort of global recession. That is why I've been recently hearing a lot of people saying, when in talking about Netflix, that it is recession resilient or recession resistant. While people may pull back on making a big trip to Europe or going on a cruise line, it seems like the market is thinking that they'd be less likely to pause their $10 or so subscription to Netflix, because people, even in a recession, if we enter into a slowdown, that sort of thing, people are probably less likely to cancel their Netflix subscription for $10 a month, which is relatively cheap entertainment. Think about what you get for 10, 15, whatever their model is these days, subscription, right? You get a ton of entertainment for a small price per month. So people still want to be entertained during hard times. So this is a way for people to, whether the good times are here or people see a rough time ahead, in both scenarios, Netflix offers a service that is affordable, and there's different tiers for different consumer levels. This is why Netflix stock, in my opinion, has done so phenomenally well year to date. If we take a look at the year to date performance of Netflix, we're looking at roughly 30%, 34% gains. That is incredible in a year where the S&P 500 is mostly just flat. However, here's my challenge with Netflix. I love the stock, I love the story, it's a great one, but everybody knows it already. The price to earnings on Netflix has gotten very expensive, and I do see this as a very expensive stock. So while I do think that this is a recession or tariff resistant stock, I don't necessarily think it's a good buy for my own portfolio at this time, and don't currently own the stock. But if we do see a drop in price, if we see some things happen in the world that do cause the overall market to fall, Netflix likely will come down with it. Just take a look at Netflix seeing some share price falling during all of the tariff trauma, but you can see just how resilient, how relatively strong this all was during this time. So that's why Netflix is number 2 on this list. Number 3 is a stock that I own and love. This is Robinhood Markets, ticker symbol HOOD. And Robinhood is sitting back at an all-time high. How would this be tariff resilient? Well, long story short, this is the highest risk of the list in my opinion. The implied volatility on this stock is very high if you look at the options chain, suggesting that share prices could double in the next couple years, or they could go down dramatically. So this is definitely a high risk, high reward type stock because it is a very popular one. It's a very, it's a fast growing stock, which carries a lot of, upside potential, but also risk if anything were to break down. Now, why would Robinhood be a potential winner in all of this? Well, you can see it also has acted very resiliently since the April 2nd era, right, where we saw the big market drop. Take a look at Robinhood, which from the lows here has had an appreciation of 125%. Why has this stock done so well? Well, volatility is in some ways a great thing for these brokerage type business models. So for example, IBKR is another one. So you have these stocks that obviously these are market makers. They offer an exchange where people can place bets, they can buy options, they can do crypto, right? And these avenues for a stock like Robinhood are very, very strong money-making opportunities for the business. So I really like Robinhood. It's a stock that I've owned for some time here and actually picked it up for the first time in a larger quantity back in the April sell-off. I'll show you my positioning. So here's a look at my current position on Robinhood. I own 600 shares of Robinhood, and I am currently sitting on a 63.5% gain on my shares, mostly bought in the recent kind of months during all of this craziness. However, you'll see I also have a covered call position sold on Hood. You can see I have the $75 calls out to the 13th of June. This is basically hedging my bet a little bit and selling because I do think, or selling this call because I do think while this has had an incredible run, I would go ahead and take profits if we do close above that 75 level. That is essentially what we're doing when we're selling a covered call. It's a way to collect premium or make money in the short term, collect a payment essentially from the options market in exchange for the willingness to sell my shares to the buyer of those calls in the event that we see a significant upside move and we trade at or above that level by the expiration date, 13th of June. And you can see just how nicely this RSI kind of oversold status plus a company that I believe in for the long term introduced a really good buying opportunity. Now, I did not get it at the lows. I ended up buying it a little bit later, but this is a stock that I've wanted to own for a long time and finally got the opportunity to buy it at what I thought was a discount. Now, this is still an expensive stock. However, I do think that it warrants a high valuation because of the significant growth of the company and the many new business avenues, including the kind of betting market world, which is highly lucrative that I think that they're breaking into now. They also offer crypto and they are a leader in the zero commission trading platforms out there. Just a reminder that if you're enjoying this video, make sure to hit the thumbs up button and subscribe if you're new to my channel. This channel is very brand new, but I love talking stocks. And if you do too, consider subscribing so you can see more in the future and hitting that notification bell so you get notified whenever I post a new video. Now let's talk about some stocks that could get hit in the event that we see more tariff trauma. The big one and the obvious one is Amazon, which of course is heavily involved in the imports and exports world. Think about a lot of the knickknacks and things that you can buy on Amazon are coming from places like China. And so when you have that imposed kind of scenario, it could lead to the consumer spending less on these platforms, and anything that threatens the massive, volume that Amazon does is a potential problem. So if you are somebody who thinks, this tariff stuff is not done, you think this is going to be a larger problem than it currently is, Amazon might be one to be a little bit more cautious on. Now, full transparency, I do own this stock personally and think in the long term that tariffs won't cause us to come to a grinding halt. That being said, I have to acknowledge, even as a long-term shareholder, that we could see more trouble ahead for Amazon if all of this tariff stuff escalates further. And even with the drop-off in share price, the price to earnings ratio is still quite high on this stock, in my opinion, at 30 PE as of the kind of Q1 with this big drop-off in share price. You can see where it was. That's still, in my view, an expensive stock. However, Amazon is one of those weird stocks that has been expensive for pretty much its entire life cycle, and yet it does very, very well. Another pretty obvious one that has had a real breakdown in momentum is Apple. And this is a stock that I already didn't really like before the tariff stuff, simply because of the lack of keeping up with the AI trade, which was a big thing I talked about last year and why I didn't love the stock. And when we melted up on the whole, Tim Cook and Trump buddy situation, I actually took that as an opportunity to be completely out of my shares, did not own Apple anymore. And while I do own a little bit of Apple stock, this is one that I'm very cautious about for the intermediate period, because again, there's some headwinds now. That same dynamic between Trump and Tim Cook that was so positive now actually seems to be kind of a negative catalyst, because there's been some butting of heads, if you will, between these two big leaders in the world. Now, tariff stuff aside, I also really have an issue with the price to earnings ratio and the evaluation of Apple as a whole. People are very much in love with this stock, and I understand it offers one of the coolest products that capitalism has ever been able to produce, the iPhone. It's a beast of a product. It's so cool. The whole fleet of Apple stuff is amazing. I wouldn't dispute that for a second. I'm even wearing an Apple-related product as I do this video, and I love many of their products. However, in this world where we're seeing AI rapidly change the landscape, I feel right now that Apple has not proven itself as a forefront leader in the AI stuff. I think about this personally just from an anecdotal level. When I look at my iPhone and I ask Siri to do things at this time, it is very weak in terms of what it's able to do, at least on my personal, experience, right? It's not able to jot down notes for me or do many of the things that things like ChatGPT and Grok and all these, and Gemini, even these things can do so many powerful tools and resources. I feel that Apple at this time is falling behind in that. They recently had a shakeup in leadership on the AI front. And so there's just all of this headwinds that I just don't like on the AI side from last year. It was part of the reason why I've been out of the stock until the recent sell-off. I believed it got a little bit overdone. And I do have some Apple shares. I can pull this up here. AAPL. We can take a look at this. So I do have shares. You can see I got it at a pretty good price. Got it during all the sell-off craziness. So I am up 10 or 11% on these shares. But this is probably a candidate where if we get a couple up days, I'll sell some calls in this one. If I get called away, it will have just been a trade for me. It's not something that I'm, massively bullish on in the long term, but hopeful. And again, when the price got so low, I decided I wanted to at least take a little bit of a stab on Apple, just get some exposure. However, my big thing that I'm looking for personally as a shareholder and as, somebody who wants to hold this stock for the long term, I love the products, like I said, but Apple Intelligence needs to come through, right? They really need to get the ball rolling on that because it has the massive potential to be a game changer. But I feel that with each month that passes on that they are falling further and further behind in that trade, they're losing a lot of their edge and almost, going to need to kind of cave in and just let ChatGPT and all these other things that are way ahead dominate their ecosystem. And here's a bonus stock that I think is very susceptible and pretty obviously so to the whole tariff trauma. That's going to be Delta Airlines. Of course, flights, if we see a dramatic slowdown in the economy, could massively take a hit. And we've seen Delta like in 2020. You can see how dramatic this stock can move. Take a look. Here's the 2020 move lower, just a massive drop. This stock is very susceptible to recession concerns. And while, I don't necessarily think we're going into a recession, if we see worsening tariff stuff, it's very possible that we get more of this kind of move that we saw in response to it between February and the April lows. Make sure to comment the stock down below that you are watching, and I'll make sure to try and cover it in a future video. Thanks for watching.